As we move deeper into a rate cut environment, which Canadian sectors are going to own the charts? Hold on to your seatbelts, folks. This is going to be a good one. To understand where we are going, we need to look at how this has all come to pass. How did we get there? This story, of course, began, as many stories do, with a pandemic. It was a time of lockdowns and government supports. In other words, the money printers were working in overdrive for sure. All that cash hitting the economy was without a doubt the major factor for the coming inflation storm. There were additional factors, such as supply bottlenecks, labor market challenges, and some significant shifts in overall consumer behavior that played a role as well. But the fiscal stimulus measures own much of that blame. Inflation was, of course, the result, and it was supersized for sure. The Bank of Canada responded to this rising inflation by implementing a series of interest hikes aimed at, well, cooling the economy and bringing inflation back to its target range. We entered the pandemic with an interest rate of 1.75%, and that rate was then cut down to 1.25% in early March. And once again, as we got towards the end of the month, they cut it again down to 0.75%, and then in early April, right down to 0.25%, actually April 3rd to be precise. It stayed at 0.25% for almost 2 years, right through most of the pandemic. Of course, on the flip side, inflation was relatively fine in 2020. And as we hit January of 2021, it was actually only at 1%. 1 year later in 2022, it was up 5.1%. And by June of that year, it was out of control at a high of 8.10%. The Bank of Canada responded well before we hit that high. They began in March of 2022 with an initial 25-point hike, taking the rate up to 0.50%. Rate hikes were aimed at cooling the economy and bringing inflation back to its target range. Higher interest rates tend to reduce consumer spending and, of course, business investment, thereby slowing economic growth and alleviating inflationary pressures. They kept raising those interest rates until eventually they hit 5% by July of 2023, and then they paused as they deemed rates high enough to get inflation back down to that 2% target. Inflation was a little sticky, but it did come down, and after 11 months of pausing, it finally was time to start cutting those rates. After 3 rate cuts, we have an interest rate of 4.25%, and we have reached 2% inflation. Needless to say, there are more rate cuts to come, a lot more. Lower interest rates can stimulate economic activity by making borrowing cheaper for consumers and businesses. In anticipation of such a shift, investors often reevaluate their portfolios to capitalize on sectors likely to benefit from those lower rates. An interesting fact, a sub to the channel is one currency that is 100% inflation proof. We are going to look at 3 sectors that should do very well in a rate cut environment. And we do have 3 months of data to see just how well and who are the top performers in these sectors. So without any further ado, let's do this. We're going to start with number 3. And we have the consumer discretionary sector. This sector is off to a slightly slower start than the other 2, but I did include it as I do expect it to really take off as we get a little deeper into the rate cut season. Nonetheless, a few of the companies have done really well. Here are their top 3 companies with their total returns for the last 3 months. So essentially, their response to the rate cuts. Coming in at number 3, we have Gildan Activewear, ticker of GIL, and they have a total return for the last 3 months of 22.84%. That's really not too bad. And as people begin to spend more money, companies like this are going to do even better. Up next, we have Aritzia with a ticker of ATZ. Their 3-month total return, 32.09%. They are doing absolutely great. And like Gildan Activewear, they're definitely going to benefit as people begin to spend more money. Finally, within consumer discretionary, the top performer is Leon's Furniture with a ticker of LNF. They're up 39.23% total return over the last 3 months. That's pretty darn good. I guess people are buying new furniture. Okay, now the next 2 sectors are ones that I think they're no-brainers, but we'll start with the utilities sector. This is another sector that I am very bullish on, and I do expect to see a very solid performance from many of our favorite utility companies over the course of the rate cutting cycle. I will, though, caution there's at least one company in the utility sector that we probably should put some caution flags around. You guys know who I'm talking about, AQN. They're just not performing. I absolutely can't recommend them at this point in time. But let's get to the winners. In our third spot within the utility sector, we've got a dividend king. We got Canadian Utilities. So their ticker is CU. And in the last 3 months, they're up 20.62%. So that's not too shabby for them. Gotta love it. Now, I mentioned they're a dividend king. That means that they have raised their dividend every year for the last 50 plus years in a row. That's pretty good. Up next at number 2, we have Capital Power with a ticker of CPX. They're also doing well. They're up 25.74% over the last 3 months. And at number 1 in the utility sector, this is a good one. TransAlta Corporation, ticker TA, and they're up 44.74% in the last 3 months. Keep in mind, that's your total return. So the dividends are baked into that number. That's just really good. I don't know if real estate's going to be able to beat that 44.74%. If any sector can, our number 1 sector sure can. Real estate, as I just mentioned. If you've been following this channel, it will come as no surprise that real estate has taken the crown. This is a sector that thrives on rate cuts. And I have some really huge expectations for them. Coming in at number 3, we've got Dream Office REIT, ticker of D.UN. Their total return right now sitting at 27.03% for the last 3 months. So that's not too shabby, and that's number 3. At number 2, we have H&R REIT. So HR.UN, their total return for the last 3 months, 32.10%. Once again, that's looking fantastic. Now, our top getter, and yeah, this one takes the cake of all of them today. True North Commercial REIT, TNT.UN, total return 56.26% over the last 3 months. Holy banana bread. You're not beating that. You are not beating that. That's great. Very, very great. 3 sectors, a lot of winners, and a lot of opportunity. This is what happens as the rates fall. So, what happens when the rate cuts are done? Well, once we hit a pause on the cuts, these stocks will find their equilibrium and they will settle into a normal market trend. The big growth, for the most part, will be over. Of course, if rates do get hiked again, they will respond as normal. One thing you must remember is that once we are through the cuts, it is not going to be a large hike again unless something drastic happens in the economy. For the most part, it will be an odd hike and an odd cut and a lot of holding steady. Under these conditions, these stocks will maintain their footing. Their total returns will come down, absolutely, in that period. And that's where you would have to reevaluate if they're still a good fit for your portfolio. If you are interested in any of these stocks we mentioned today, don't forget to put in a whole heaping helping of due diligence before you place any of your hard-earned money on the table. Well, let's continue that learning journey. Check out this video on high dividend growth stocks, and I will see you in the next video.